There's a conversation I end up having quite a lot with founders who are looking at Dubai, and it usually comes up when we start talking about tax. Someone will say something like, "So, if I set up a company in Dubai, does that automatically mean that it's only taxed in Dubai?" And the answer is not quite, because when you're dealing with international tax rules, the real question isn't just where your company is registered, it's where the company is actually being managed from. And that's where something called central management and control, or CMC, becomes really important. Every country has slightly different rules around this, but if we take the UK as an example, HMRC doesn't just look at where a company is incorporated, they look at where the key decisions are being made, where the directors are operating from, where the company is being run from on a day to day basis. So, in other words, where the business is genuinely being managed. And if someone sets up a company in Dubai, but all the decisions are still happening from the UK, all the strategy is coming from the UK, and everything is effectively being run from there, HMRC can argue that the real management of that company is still in the UK. And if that happens, the company could still be treated as a UK tax resident, meaning UK corporation tax, which is obviously not what most founders are trying to achieve when they start exploring Dubai in the first place. This is where something called substance becomes really important. Substance basically means demonstrating that the company is genuinely operating from the jurisdiction where it's based, that there are real activities happening there, real decision making, real oversight. And that's something that founders often underestimate when they first look at international structures. They think the big step is forming the company, but actually, the bigger question is, how is the company run once it exists? This is one of the reasons services like our regional management support exist. The idea is to make sure that the company has a proper director presence in the UAE. The company's decisions are being handled correctly, that compliance and governance are being maintained locally, and that there is a real framework showing that the company is being managed from the jurisdiction in which it is based, not just on paper, but also in practice. Because when international tax authorities look at structures, they don't just look at documents, they also look at things like behavior. They look at where decisions are being made, they look at where the business is actually being run from. And once founders understand that concept, they usually realize something important. Setting up a company in another country isn't just about opening the company, it's about making sure that the way the business operates genuinely reflects that structure. And when that's done properly, everything becomes much clearer from a tax and compliance perspective, because the structure and the reality of how a company is run are aligned, which is really the whole point of doing it properly in the first place.